Responsible investing funds have been a hot topic in 2020. The Financial Times reported that the inflow of these funds quadrupled in the past year. As the seriousness of global warming and the effects of a global pandemic continue to take their toll, as investors, we've started to realise that we all play a role in protecting the world that we live in. And in 2020 at least, these investors have been rewarded, with some significant returns being associated with some of the top funds. Morningstar published a list of the top performing ETFs which show the Invesco Solar ETF gained 238% in 2020. This ETF invests in innovative solar energy companies all over the world. So, as more of us lean towards sustainable investing, the importance of where your money is invested matters. Let's have a look at how we can all invest in a socially responsible way, and if we can truly have a positive impact on our planet. Hello everybody, my name's Lewis and welcome back to iQinvesting, where we talk about saving, investing and everything in between. Make sure to subscribe to the channel and follow us on Instagram at iQinvesting UK for more stock market related content every week. The main goal of socially responsible investing is to supply capital to those companies that you think will make the world a better place. These can be firms that are at the cutting edge of the green revolution, or firms that uphold strong ethical principles. But how do we decide which companies get the title of being socially responsible? Let's get into it. Well, to begin, we've first got to define what it means to be socially responsible. And the thing is, it's really subjective. What you define to be socially responsible is completely down to your own ethical and moral philosophy. In the UK, certain industries such as tobacco and gambling are closely regulated. This gives us some insight into which industries can be considered socially irresponsible. But is it that straightforward? Which conducted a survey in May 2020 where they asked people which ethical topics they considered when investing. As you can see, it's a mixed bag. The environment was considered by 27% of people, whilst gender equality was only an issue for 14% of people. Basically, it's not clear which companies should be included. Further to that, 43% of people don't even consider any ethical issues when making investment decisions. Thankfully, we do now have more control in what we invest in. Financial services now offer specific funds that focus on ethical companies. Currently, the best way to invest in these companies is through ESG funds. ESG stands for environmental, social and governance. These three concepts are at the heart of responsible investing. Environmental covers companies that are tackling issues such as global warming and climate change. These companies promote sustainability considering the full life cycle of their products, from reducing manufacturing waste to end-of-life recycling. The social aspect is linked to issues such as human and animal rights, promoting diversity, and firms that give greater consumer protections to improve our society. Governance is slightly less glamorous and focuses on companies that lead the way in terms of employee relations and compensation. To determine which companies are suitable for ESG funds, they are ranked based on each of these categories. This is called their ESG score. Many index companies, such as Standard & Poor's and FTSE, create their own scoring systems that fund managers can use. So, you might think, can't I just choose one of these socially responsible ESG funds, invest in it, and forget about it? Well, not quite. We'd suggest that you look at the companies that are held in these ESG funds to ensure that they match your personal investing ethics. This is because recent studies have shown that some of these ESG ETFs may invest in controversial companies. According to research by the think tank Commonwealth, a third of climate funds that are sold in the UK invest in oil and gas companies. This raises concerns that investors may be misled by sustainable investment products. The study looked at the composition of 33 low-carbon ETFs in the UK and found that 12 of them invest in one or more oil and gas companies. This is not what you would expect at face value. This could be linked to the wider issue of greenwashing, where green credentials are overplayed in an attempt to attract investors to the company. An example of this would be a company investing in green initiatives to offset their significant carbon footprint. This is tough for everyday investors like you and me to get around, especially when trying to choose an ESG ETF. We need to ensure that the funds that we invest in are transparent about the companies that they hold, to ensure that they align with our personal investing ethics. To check which companies a fund holds, be sure to check the key investor information document that all UK funds must supply. Now, let's have a look at the potential returns associated with responsible investing. When considering any investment, we need to weigh up the potential risks and returns that are associated with it. Larry Swedroe has written an excellent blog post on this topic that covers some of the literature on expected returns for ESG firms. Larry notes that socially responsible investing now accounts for $1 in every $4 under management in the US, and 1 in every $2 in Europe. To understand how high-scoring ESG firms perform, we need to first compare them to low-scoring ESG firms. This comparison will give us what is called the ESG premium. Basically, we are looking at the difference in returns for the two options. A paper by Ciceretti et al. Contributed to the literature in their December 2019 study the contributions of betas versus characteristics to the ESG premium. The authors used two sets of global data that included roughly 6,000 firms for the period from 2004 to 2018. It found that companies with a lower ESG score had higher expected returns. The average excess returns decreased as the ESG score increased. But this doesn't match the results that we saw earlier, with some ESG funds earning over 200% in the past year. This could be explained by the short-term gains rather than long-term returns. The lower expected returns for high-scoring ESG companies can be explained by their popularity. As people have more desire to seek out and invest in these firms, the stock price starts to become inflated. This is because people start buying the stock for the ESG qualities that the company has. The investments are not based on the value of the company. As more people buy the stock, this causes the stock price to rise higher than what can be explained by the company's fundamentals. Despite the increase in stock price, the expected returns of a company does not change. This is because the ESG qualities do not affect the future cash flows of a company. So, if you had two almost identical companies that had the same future projections, but one had a low ESG score and one had a high ESG score, people are willing to pay a higher price for the company with a higher ESG score, despite the fact that the expected returns of both stocks are the exact same. As you are paying more for the high-scoring ESG company, your net expected returns are lower. However, before we disregard responsible investing, this data is far from conclusive. There are other studies that disagree that high ESG scores correspond to lower expected returns. Morningstar recently published data that showed that there is no risk or reward trade-off when investing in ESG companies that either have a low score or a high score. Ultimately, regardless of the returns, many investors think that responsible investing is the right thing to do, and that returns are secondary. We recommend that you really assess your own values, and if you want your investments to reflect them, you need to do some research before investing in ESG ETFs to ensure that they invest in companies that truly reflect your own values. And with that, make sure to subscribe to the channel and follow us on Instagram at iQinvesting UK for more stock market related content just like this every week. If you found the video useful, make sure to smash that like button and share it with a friend so that they can learn about responsible investing too. How do you feel about responsible investing? Do you look out for this when investing in stocks? And are you willing to accept lower expected returns for your personal ethics? Let us know in the comments below. As always, thanks for watching.